Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth Money Matters. Scott Hansen.
Pat McClain, thanks for joining us.
Yeah, glad to be with you. Pat and myself are both in the studio. We're recording this,
Today is Thursday.
Thursday the 15th of
August.
Yes, and one of the things, well, we've got a great show. We got some calls and some other topics we'll be discussing. But so it was a week and a half ago. Markets had a pretty particular bad day, and it's as the Dow gets higher in numbers. The numbers are bigger, and the swings seem so much bigger, right? So
from a point, just a number.
So a 500 point, like years ago, that was a big deal. Today it's, And I remember Pat, you were on vacation, took a little vacation, and I got someone from in the office says, "Hey Scott, you want to do a little special recording for the start of the show to let people know about the markets?" And I said, "Let's see how the next day goes." Sure enough, it was a pretty big recovery. And then if you look a week, we're only a couple percentage points below our highs.
Yeah.
Phenomenal year all in all from an investor perspective.
And the divergence between the Dow and the NASDAQ just continues to amaze me.
Yeah. Well, I think that the Dow, they haven't done a very good job of
mimicking the overall markets.
Yes.
Well, there's only 30 stocks. It's hard to do.
Yeah, and the weighting is different too.
That's right. Versus the S&P. If you want to really know what the market's doing, actually,
the total
market.
The only reason we look at the Dow is because that's what we used to do
historically.
Yeah, that's the only reason people pay attention to it.
Which I hear financial reports on the radio, and they always report on gold, and I always think, what a waste of time that is. Reporting the price of gold. What percentage of the U.S. population actually owns gold? And is it not easy enough? I just think it's and I asked someone that reports financial news, and I said, "Why do you still report on gold?" He said, "Because every time we don't, someone calls and complains."
Some gold bug. He's waiting for his day. Well, gold has been on fire the last
lately.
I'll tell you, it's funny. I was thinking about gold the other day because you can tell when gold prices are up because that's when the companies start paying a lot of talk show hosts, right? Yeah. They have the little ads on gold and why it's important to diversify and gold in your IRA. And you hear a lot, at least I've heard a lot of those lately. And I was thinking the other day, I would like to see someone put together a chart of the last 20 years, 30 years, 40 years, 50 years of how gold has performed relative to other asset classes,
right?
It doesn't produce anything.
And look, it's a commodity. People pretend it's not a commodity. Historically based, it was a store of wealth. But before that was a store of wealth, salt was a store of wealth. At one point in time, salt cost the same amount as gold at one point in time.
You mean like gram per gram?
Yes, hundreds and hundreds and hundreds of years ago. Right? But what determines the price of gold and what determines the price of salt if it's a commodity? It's the cost of manufacturing it. So there is an endless supply of gold. We're just going to go with that. There is an endless supply of gold. As we get further and further into it, the costs go up in order to actually derive it, mill it, take it out of the ground, right? And that's at the end of the day, you'll see swings in the price of gold. But it's the cost of getting it out of the ground and putting it in usable form.
Yes, I just put the price of gold's about $2,500 an ounce, up 20% year to date.
That's pretty good.
Financial market's the only market I know when prices are up, people get more excited, they want to buy more, and when prices are down, they want to sell.
Correct.
Right?
Yeah.
Hey, gold's up 20%. Maybe we should buy. It makes it's. Yeah. Well,
it's what it did. It's not what it's going to do. Remember, anytime you look at the price of an asset or the growth of the asset, it doesn't tell you what it's going to do in the future. It actually tells you what it did in the past. So you could make the argument that you should be living in the assets that are down, not up.
Be pure contrarian play.
Pure. And owning a actually broad index of stock, you're covering both bases. You've got the momentum stocks and you've got the stocks that are out of favor, right? You've got them both covered. You're not going to get rich, but it's a great store of wealth, right? The stock market goes down on average once every 3 years.
That's right.
Once every, by 10%.
And 47% of the days they're down. So pretty much a coin toss. Any day.
Once every 6 years, the market historically has dropped 25% or more. You're like, well, why would you buy anything like that? Well, because it goes up more often than it goes down. And it's called a risk premium, which is you're going to have to live through the bad things if you want to. I've been married for 38 years. I consider myself pretty happily married, right? You talk to anyone that's been married for 38 years and you ask them, how long have you been married? And if they say, well, I've been happily married for 38 years, I always think you're a liar.
That's right.
It wasn't all happy.
I've been married 32 years. Full disclosure. Yesterday afternoon, we're driving to a counseling session that we had set like a month prior, 3 weeks prior.
I call them tune-ups.
Yeah. And we're actually at a really great spot. We had a couple days together, just the two of us with no kids. We were at a really great spot. And I think I said, what were we going to discuss today? Why did we set up this appointment? Right? Yeah, we worked through whatever it was. We were
volatility in life, volatility in market. It's a fact, right? You and I have been business partners for 30 years.
Yeah.
Volatility in the relationship,
right, of course.
Right? Anyway, so if you, we're going on, we should get to the calls, but I could go on and on that equities in the good and the bad,
for long-term investment.
Long-term investment.
5+ years.
Yeah. And then later on in the show, I want to talk a little bit about real estate and these non-traded REITs and what the real estate distributors are actually doing.
All right. Well, let's start with the calls here. Let's start off with Chris. Chris, you're with Allworth's Money Matters.
Hey, good morning. So as far as getting on or getting close to where you're pulling your money out of like IRAs and pensions and stuff like that. And the portfolio and stuff, how do you get rid of that anxiety of making that correct choice of what you're going to sell and et cetera? I've done a little bit of it because I have a beneficial IRA, which I have to pull a little bit out of it each year. But
how old are you?
Now that I'm getting close, will be 61 this month.
So this is.
And when do you plan on retiring?
I could hopefully retire soon.
So this is a common. First of all, it creates anxiety for two reasons. One is the portfolio, the asset allocation, and the volatility, and the other is you've probably saved a good part of your life, your working career, and have not ever spent any of that money, and it always sits there as kind of this, this thing that it's going to, get me through the hard times, and then all of a sudden you quit working and there's no job, and you have to tapping into this.
You're no longer stacking wood on the wood pile, and now you're pulling it out.
Yes, and so so there's two things that run it. One is the emotional, and that's really hard.
And I'm going to add one more, Pat, because now you've got time, right? Because you're working, and maybe it's a really bad day in the market, or a bad week, or a bad month, or a bad quarter, and you're like, oh, this is, but I got work to do, and you can put it off, and you focus on your work. When you're retired, you wake up. Like, what do I have today? Well, I got a barber at 2:00 on Tuesday, and then Wednesday. Right? Like, so you've got all this free time, and you've got a lot of time. If you want, just sit online and start going down these rabbit holes of whatever kind of economist you want to follow,
and question all
drive
your
yourself
decisions.
Crazy. Yes.
So, what does your portfolio look like now?
Well, I mean, I'm pretty well diversified. Of course, probably too heavy in tech, but I've got about 80 plus different stocks in a couple different IRAs and pension, mostly self-directed. So
And do you use any mutual funds or ETFs?
within that, I've got 3 or 4 ETFs. But as a total, I would say it's probably, I don't know, 0.5% total. And that was kind of my point is, do you see people going more to where they invest more in ETFs where it may cover a broader base versus like selling 1 or 2 different stocks at a time? Or
yes. Look, I'll just go to myself. If you looked at my individual portfolio, right, overall, I probably own 3 stocks, and the rest are broadly diversified ETFs or mutual funds. And
Well, I own several hundred only because I have a synthetic index. So it's called direct indexing. It's essentially an index that is custom built, which we do for some of our clients.
And
as
you
well.
do that in a brokerage account for tax efficiency.
It's all for tax efficiency.
tax
so you end up
efficiency.
spending more. It's much more expensive than just owning an ETF, but it's designed for tax efficiency. But
How much money is there?
a little over $3 million.
And how much do you plan on actually taking out when you retire?
Well, I mean, they tell you what rule of thumb's 4% a year, something like that.
Yeah.
You know, so I mean, the anxiety is not there. It's not like I'm not worried about running out. I'm worried about, like, I don't know, missing, like, oh, if I sell too much Apple, you know, and then all of a sudden it has a great run, or you know, sells, you know what I mean? It's like, what do you? The anxiety of selling the wrong thing.
That's that is never going to go away, right? That is never going to go.
Well, I
away.
mean, one way to diversify. I mean, one way to deal with getting out of it is anything in a retirement plan where there's no tax consequences. Get rid of your individual equities and buy index funds.
Yeah, right. And that was a thought, but I'm just.
So you plan on taking $120,000 a year out of it?
No,
Well, I don't know.
I don't think you will. By the time you have your pension, you get Social Security as well as a pension.
Yeah.
Yeah, my guess is.
And how much will the Social Security and pension make up as a percentage of your current income?
Well, I mean, it will be 100%, I guess, right?
Well, no.
What's your salary now? Or take home pay? I mean, before taxes, annual compensation.
Oh, it's lower than 120. I mean,
Oh, you can do anything you want.
yeah.
No, I mean that's the reality. If look, the reality is you don't need this $3 million to live on. Is that a fair statement? That you'll be fine
It's fair.
with
But
just
I don't want to leave it all to anybody else.
Well, I think I think the important question for you to grab is like, what is the plan for these dollars?
what's the purpose? What's my thesis around these dollars, right? So if the thesis around these dollars is I'm not going to spend any of it, well then keep it all in equities and manage it for the next generation. If the thesis around these dollars is I'm going to spend $120,000 a year, then you want the portfolio to be probably 75% equities and 25% other fixed type assets. And that way, you actually draw off the fixed type assets in a down market and in an up market.
Yeah, and I mean, I think it's really important to determine, like, how much of these dollars do you want to for your lifestyle? And you might say, I'm going to spend a little bit more. You probably won't, because the reason you have these dollars is because you've been a good saver and relatively conservative on your spending. And my guess is you don't get a lot of joy by just wasting a bunch of money somewhere.
And
it probably bugs you more than you would get joy wasting money somewhere.
And a fairly aggressive investor, which is paid off over the long run.
Yeah.
And so if your goal is to die with as much money as possible, that would be just saying if that was your goal.
No, not really.
So what is the goal with these dollars? Is it do you have children?
Oh yeah, yeah.
I mean, is it to help your kids? Is it to give to charity? Is it you can't take it with you, right? So
I'm not so I'm not so worried about them. They're all working great jobs and all that, and so I think they'll be fine. If there's something left at the end, that's fine too. But I don't, plan on spending money, travel, enjoy a few things, typical retirement stuff, I guess.
I got to tell you, if I was sitting in an office with you and we were discussing your financial situation, I would tell you, and you don't say this very often, you need to increase your standard of living. I would start a 2% distribution off this immediately. And then I'd look at Roth conversions for any amount that we could. And I would send it to you. Look, I'll tell a story. I have a client. He's 81. He's been with me for 23 years. Maybe he's 82 now. And he came to me with, $8 million. Great saver, no children.
Modest lifestyle.
Modest lifestyle.
Yes. That's why he had the $8 million.
Right, modest lifestyle. I got him to start spending money. And it took a series of years. And I said, look, I'm going to send you a check for $25,000 a month, and you cannot give it back to me. You must spend this. So the next thing you know, I'm talking to him. He goes, Pat, I really like this first class thing on an airplane. He said, when I go on cruises with my friends now, we stay in the nicest cabin. He said, it took years to change the mindset. Now I send him $40,000 a month, and the account value is well over $10 million. I think it's probably $12 million now. And the point being is, look, he saved it for years and years. And his investment, his spending thesis didn't exist. All he knew is how to save.
And to that point, Pat, not everyone wants to increase their personal consumption.
That's correct.
Right? So you have other clients that have given to charities and gotten really involved in charities. And suddenly, rather than leaving it in part of their will, they're like, we're going to allocate X dollars every year and we're going to be more involved in it. And so it's not just like we're going to go consume it on first class tickets and cruises. Maybe that's not your thing. But it's I think what would be helpful for you is really looking at these dollars and saying, what's the purpose of these? Because part of it's a game, right? I mean, you've done a good job over the years. And your concern now is, boy, I sell the stock and it goes up, and it's a game. It's right that you don't want to lose the game.
You're right.
So
right.
I think the game maybe is like, what's in this next chapter? What's the game?
Right.
How much money do you have outside?
Yeah.
How much money do you have outside IRAs?
Probably close to 2, something like that, with the house and other properties.
Okay, yeah, but when you say other properties, are they investment properties or?
Not really investment properties, like an office and a little bit of dirt.
Okay, those are investments. Because once you retire, you're not going to.
Well, okay, yes.
Yeah.
Yeah.
So
house.
You may not think you need it. But Scott, you started the show by actually saying that you and your wife were going to a counselor just for kind of a tune-up, right?
Yeah, we do a couple times a year.
Yeah.
Same woman we've been seeing for years.
Yeah, but it's just like, are we all on the same page?
We have teenagers in the house that we're trying to survive.
Okay. Hopefully they don't listen to the show.
Of course not. They're too consumed about their own life. What's their hair look like?
You might benefit from paying an hourly fee to sit down with an advisor for a couple hours and actually doing a financial plan that actually makes you more comfortable in your situation. Right.
Okay.
In terms of your asset allocation. And there's modeling. You can model a portfolio that shows you exactly what happens over time based upon market conditions. And then you look at the portfolio and you say, well, maybe you said you're probably overweighted in tech. If you own an index, you've got a lot of tech in it anyway.
Sure.
You may benefit from actually just smoothing the portfolio out a little. And I'll tell you where you'll really benefit from it is the tax efficiency on the brokerage side of the balance sheet.
Okay.
But you're obviously you could take all this money. I'd make the argument that you could take all this money and put it 100% equities, based upon your current thesis of you're not going to probably spend it.
Yeah.
But I think it's a combination of the two.
Okay.
So,
Yeah.
I wish we were
All right,
more
Chris.
help.
This,
Yeah. Real world problems. Huh?
my guess is when you're a young man, you didn't think you'd have this problem at this stage in life, but it's
Oh, no.
yeah,
Yeah. Well, you created it.
yeah.
It's a good problem to have.
It's so interesting. I appreciate the call, Chris. It's so interesting how our mindset, our personalities, our hopes and fears, our comfort with unknowns, like all that plays into the finances. And some are just good savers from day one. My son is that way, just from day one.
Your daughter?
Good spender from day one. Yeah, very different. Yeah. Raised the same household, same values, very different, extremely different. Their approach to finances. But those that tend to be good savers are usually have some concern about the future, and they're saving to protect themselves from some unknown calamity.
I understand his anxiety.
Oh, I do too. Right? Of course. It's part of the natural tension. And then the challenge is as you get kind of the stage in life where you started to save for it to begin with, right? Most people's like, I'm saving for the future. Then when the future's there, it's hard to change that mindset of going from being a saver to spending.
Scott, it reminds me of a call we took a few weeks ago. And then we did a follow-up house call with him, a gentleman whose wife had these terrible heart issues. And and he just couldn't get himself to spend the money to make their life more comfortable in these really difficult times. And that's an extreme example, but you have to create a thesis about what your desires are. What is your goals with the money? And then the investment asset allocation follows that.
And I think the goal, I mean, it changes. It can change. For most Americans, it's still, I need enough money saved so if I can't work, I've got some money. That's the majority of Americans. But if we look at the top 5 or 10% of wealthy people in the United States, a lot of that comes because people are just good savers. And as we, just like the last call we had, suddenly he was probably saving for retirement. Now he's almost he's retirement age and has way more than he needs for retirement.
Yeah. And then he has anxiety over that. The allocation.
Right. Well, yeah. And to your point, like having some clarity on what these dollars what are they designed for now?
He has a great issue with fear of missing out.
Yes. Sell the stock goes up. By the way, kind of just a rule of thumb. If you buy a stock, it will go down the next day. And if you sell a stock, it will go up the next day. I don't know if there's actually studies to back that up, but it feels true to me.
And he'll be fine.
All right, let's continue on here. We're in Virginia talking with Lance. Lance, you're with Allworth Money Matters.
Hey, Scott and Pat. Appreciate you taking my call.
Yeah.
First, I want to tell you, in the last 6 months, I've enjoyed 4 years of the podcast, and even listening to you from the future, I've given you a 5-star review. So
okay, well, thank you. Thank you. You're in Virginia. How did you come across the podcast anyway?
It just ended up in my feed one day, and I started listening to it. Went to the very start, and just started listening to it I drive a lot in Southern Virginia, so
I don't know how far back we have. We've been doing the show for 29 years, so we don't have 29 years on it.
It only took me back to October of 2020, so that's as far back as I could go. So,
all right.
So a little background on my question. I have a 26-year-old son. He recently got engaged, and thanks. Next springtime, him and his fiance will go ahead and tie the knot. So I was thinking about it. My wife and I were kind of comfortable in our financial roadmap, and I'm pretty comfortable or I'm pretty sure that her parents are the same. But having just done some recent financial planning, I thought it'd be good to get them a financial plan. So I'm going to gift them a financial plan for, I guess, for the start of their marriage. But my two questions is the first one, because I'm going to do it, is do you think the timing would be better is give it to like a Christmas gift so they can do it before the wedding, or just wait until the wedding and give it to them? The second question is more, as financial planners and dads yourselves, have you seen that this unsolicited help does it really do anything?
You beat me to it. Listen, Lance, you beat me to it. It oftentimes goes poorly, right? Because it implies that they are doing. It implies, it's not the truth. I think most people can benefit from a financial planner, and I have plenty of nieces and nephews that come to me when they're purchasing a home or
a life event,
or they get a new job and like, what do I do with my old 401k or IRA? And then I allocate for them. But they come to me. I don't go to them. And so the danger, and I've seen this at least a half a dozen times, where the parents kind of push it on them. And
these are dad's values.
Yeah.
I know dad's values. I've grown up with dad's values.
and so they'll resist it. I've seen it other times where there's substantial amounts of money and the money's going to go downstream, and the parents say, "Look, you're going to inherit this money." And
it's a different discussion, though.
It's a different discussion. What you want to do,
and I think, Pat, I just think how many times over the years I've had clients, can you talk with my son? And they are with the hopes of getting something set up. The son or daughter never. And the very few times over the years that I have, it's always uncomfortable because you can tell the kid's doing it just to make dad or mom happy.
Yeah.
And
so what I have found works the best, and I've coached clients that are like, I'd like my kid to come and do this, is you get the child to ask, and you say, look, it's. I've had this advisor and this is what they've done for me, and they work with young people. And normally if it's like, hey, if you have a 401k, do you want this advisor to actually look at the portfolio and make the selections for you? So it's a soft introduction, and your advisor should happily do that for you, right? It's not, it'd take an advisor 10 or 15 minutes to look at all the choices and then, build a model and give it to the kid and then start the relationship. But the things that they're going to tell your child aren't super popular, which is, look, you should buy some term life insurance, right? And the kid's like, well, I'm not dying. My wife's not dying. You need to save 10% of your income. You need to maximize this 401k.
Well, you're spending too much. You've got this credit card debt here. We're going to need to figure this out and cut back.
Yeah. So I wouldn't do it. I wouldn't. I would talk about my advisor to my son, right?
Yep.
I have a son.
I would think offer it up. Say anytime you guys are ready for that, I'd be happy to pay for a financial plan. And
easy enough.
I think I'd do it like that, as opposed to Christmas morning they open up and here's a gift. Hey kids, get a phone. Dad's values.
Oh yeah, and by the way, here's a gift certificate to a weight loss clinic. Right? You're like, you're looking at dad like, what? What? So it's funny because my 28-year-old just got engaged. And last year he came to me and he said, hey, do I need a financial planner? And I said, well, I've kind of been acting as your financial planner throughout the years, and, I allocated your 401k and I tell you what to do with the cash and this and this. I said, you're not ready for a formal relationship with a financial planner, but he's got one in me, right?
Yeah.
But if he didn't have one in me, I'd say, yes, you need a financial planner. And probably next year after he gets married, he's going to sit down with a financial planner because he needs to be told you need to buy X, Y, and Z, and these things are not super popular, but you need to do it. Fortunately, this kid's pretty responsible. He has the first dollar he's ever made, and he has tried to spend.
You do have 4 kids, though, right?
Yes, they're all. It's funny how they treat my money versus their money.
Yeah.
So I agree with Scott. Just sit down with them, say, this guy does great.
And really, the most important thing for someone in their 26 years old is their career. I mean, I think particularly the 20s, latter part of your 20s, if you're not focused on your career, I mean, that's where wealth is going to come from, one's career. Maybe someone gets lucky and inherits money, but it's typically one's career. Maybe they have a business, they're just good at their job, they move up the ranks. That's where, that's where wealth really comes from. And I think that's when you're 20s, that's super important to focus on your career.
I like Scott's approach, which is the soft approach.
Yeah, I kind of like that idea.
Yeah, the soft approach. Well, you should. It's your idea.
Oh, I have bad ideas too sometimes.
So anyway, appreciate the call. And
absolutely.
How many children do you have?
I got two. I got the oldest is a son, and then I got a young, soon-to-be lawyer. So we'll see how that goes.
I've got one of those.
Soon-to-be lawyer.
Yeah. Yes. Yeah.
So that's just the two.
Public defender, by the way.
Oh, appreciate the call. It's interesting. I mean, I know lots of attorneys, and there's so many different types of practicing law. And so, like, when someone says attorney, I don't put them in some box like, oh, this is what your career must be like, because they're could be vastly different. Personal injury attorneys are one camp, and you get public defenders and then business litigators
and corporate lawyers like we have working for us.
Yeah, there's so many different
in-house counsel. Yeah,
and I think some of the you look at someone like Dave Ramsey. Yes. He's built this big company. A lot. It's working with young people, and people have gotten themselves into debt. And the biggest issue for young people is to avoid debt, particularly consumer debt. I mean, if you can get in the habit of saving and buying a car with cash as opposed to it doesn't take that long.
Yes.
to just say, let's defer a couple of years and save X dollars a month so we have the money to buy a car as opposed to financing it. And then the rest of your life, you're financing. And that's where so much money just gets wasted.
Dave Ramsey does a good job with that population.
Yeah, with that population. Yeah, for sure. I don't agree with him on his investment approach always. But
no.
Anyway, let's go to Texas and talk to Grover. Grover, you're with Allworth Money Matters.
Hey, how are you guys doing?
We're great.
I was in the car a couple of weeks ago and caught the tail end of a show, and you were talking about a caller's spouse could file for one half of his Social Security. So that intrigued me. My situation is my wife is getting Social Security. It's not a big amount, and I get mine. Files for half of mine. Does that come out of my portion?
It doesn't. It doesn't affect yours at all. And you're both receiving it now, correct?
Yeah, that's correct.
I suspect that you actually she'll get the higher of the two.
Well, example numbers. If she's getting $1,000 a month now, I'm getting $4,000. She files for my half.
How old was she? How old was she when she started hers, and how old are you when you started yours?
65. We're 72 and 74 now.
You both started at 65?
Yeah.
Huh. You both started at the same time, and she took hers.
No, she started 2 years after me because she's 2 years younger.
Yeah, so both started at the full retirement age.
Yeah. You need to go back to Social Security.
Yeah, I'd have a conversation with Social Security.
Yes. You need to go back to Social Security. It would be the higher of the two, but it doesn't sound like it.
Well, my example was if she's now getting, these are just numbers I'm picking out. She's getting $1,000 now. I'm getting $4,000.
That's right.
If she files and gets half, she'll be then getting $2,000. So it's $1,000 more per month.
That's right. That's why you need to go back to Social Security Administration.
I wish I'd have known this 5 years ago.
There might be some provision in there that allows you to recapture that. I don't know.
All right. So we should go.
How long have you been married?
Social Security. 54 years.
Okay, well, this isn't a second marriage, unless you were really young when you got married the first time. Yeah, you need to go back to Social Security Administration. I've never heard of such a thing. Have you?
No, I'm just trying to. Well, it's typically automatic. You get the qualify for the highest benefit.
Yes.
Yeah.
Well, if it's automatic, then we ought to.
Yeah, we don't know the answer.
You have to go back to the Social Security Administration. It doesn't sound right. How's that? It doesn't sound right. If I were you, I would make an appointment and go down, talk to Social Security as soon as possible. And then when they say, oh, we made a mistake, then you go back and ask for the recapture.
All right. That's good news, I think.
All righty.
Good luck on that.
Well, thank you.
Yeah. It is. Social Security can get a little complicated at times.
It's phenomenal.
There used to be, you could do the file and suspend stuff, and there used to be some kind of tricks along this where you can get your half your spouse's benefit, then you'd suspend yours, and you'd wait. And
yeah. But they got rid of that.
They got rid of that. It was a few years back.
Yes.
I used to understand the rules pretty
well. I got my
there,
Social Security benefit estimate in the mail the other day.
They still send those out?
They do.
They quit for a while and they didn't.
Yeah. I'm feeling pretty good about it.
You know, it's interesting. So how old are you, Pat?
61.
61. So, and you've been doing this 30-some years as a financial advisor, right?
Yes.
35 years.
Yeah.
And imagine
Yes.
35 years ago, you weren't planning on Social Security being there for you.
No.
And my guess is you will, and when you hit your normal retirement age, you will.
Oh, 100%.
Yeah.
In fact, when my wife turned 62, which is hard to believe that I married a 62-year-old, that she'll take hers as soon as possible.
Yeah.
Yeah. She doesn't work outside of the home. So, yeah.
All right.
Good day.
REITs, real estate. You was at the top of the program. You said you want to spend more time on this.
So this came out in the New York Times earlier this week.
I quit subscribing to them.
Oh, did you?
Ago. Yeah, I got pissed off at them about something. They're not getting my $4 a month.
Actually, you know what I did? I called. I subscribed to a local newspaper online, and my wife said, "This is really expensive." And so I called them and said, "Hey, I'm going to cancel." And they said, "This off talk." And they said, "Why?" And I said, "Because it costs too much." They said, "Well, we'll lower it to $29.95 a month." And I said, I was thinking more about 19. And they said, "Okay, we'll lower it to $19.95 a month." And I thought, why did I say 19? I should have said 13. So I'll call them back in a couple months and tell them I want to pay 13.
Well, you want to talk about a challenging business model.
Oh, and actually, there's a suit in the state of California right now against Google. Well, it's legislation against Google to get paid. Excuse me, to get paid for reuse of
all the articles
that they take.
It's
a terribly, and it's a really important. I mean, the press it's unbelievably important.
It was, but it does. I mean, it's now there's.
Oh, Scott, it was important. It is important, and it will be more important again. Because there's press now, but it isn't. It's hard to. Anyway, let's not get into this. So,
but there's a changing of the guard because I think if you go to New York Times, you know what their political bent's going to be.
Yes.
Right. You go to these different.
Yeah.
I don't know. I've always thought I've thought it's perplexing why local newspapers still endorse certain candidates. Like, I understand back in the day when a town would have 3 or 4 different newspapers, right? Then you subscribe to the one that you aligned with the most or whatever. But when there's most big cities now have one newspaper left. And you would think, I mean, if I were the publisher, I would think, I want to be appeal to the widest audiences possible. I'm going to stay clear of the.
You might be more interested in making a profit than you are in espousing your views.
I am a business person.
A vast population.
Okay, well, maybe that's the point.
Right? The driver isn't the same. So naturally, you're going to see it as, how do I appeal to the most people possible?
Very fair point. How do I sell as many newspapers as I could?
Yes.
That would be my number one goal.
Yes.
You're right.
But the publisher's like,
maybe that's
life's
not
pretty
goal.
good, but I wish more people thought like
fair.
me.
I hadn't really thought about it that way.
All right. So the New York Times, this is the title of the article. It was a hot real estate trade. Now investors are worried. And this, and by the way, non-traded real estate investment trusts aren't inherently good and or bad. It's just that they can be more expensive to purchase and they lack liquidity.
All things being equal, if I'm going to buy an investment, I want to invest in something, I would like to have the littlest amount of friction both on the going in and getting out. And what I mean by friction is ease to buy, cost to buy, ease to sell, cost to sell, right? In a perfect world, any investment, whether it's stocks or real estate or I don't care what it is, I would like to be able to buy that with as little friction as possible and have as much flexibility in selling. So when I want my money back for whatever reason, I'm able to get those dollars back. So from like our firm, we manage 20 some billion for our clients. That's what we look for too with our clients. Like, what is the lowest cost to get that exposure, to get what we're trying to accomplish? What's the lowest cost, and where can we provide the most amount of liquidity so that if a client needs their money or wants to fire us, whatever they can get their money and do something different with it.
That's the thesis.
And it's only if there's some areas of the market that there's no way to get it in a public market where you have to look at some sort of partnership structure or some other structure where it adds a lot of complexity. Then we weigh, like, is it worth this added complexity? Is it really necessary?
Why make your life more difficult when you don't have to?
When we're talking about real estate investment trusts,
non-traded,
when we know there's a market out there for traded, where we can buy today and sell tomorrow with little friction, the question is, why would we get involved in these products that have friction, which you're going to talk about?
Which is exactly what people are asking themselves now that own these.
Okay.
Right?
That were sold these.
They were sold these because
they didn't buy these, they were sold.
They typically come with big commissions. So the background on this is that for years and years, these REITs were sold to pension funds. So if you were a large pension fund and you wanted some real estate exposure, you have two options. You could partner with someone local, or you could do it yourself, which happens. We're from Sacramento. California Public Employee Retirement System is the largest pension plan in the United States, right here in our backyard. So they will do both. They will partner with developers and develop some on their own.
Or they'll just go buy buildings.
Or they'll go buy buildings themselves, and use professional management to manage the buildings, or they'll buy traded REITs. But the problem with non-traded REITs is the lack of visibility into value. And then how do you dispose of this REIT? Because you're locked in, you have no control when you're getting out. You have given up that control. If you look at how non-traded REITs are priced versus traded REITs, the difference is stark. And the reason is no one really knows what the value of a building is until the day it sells.
Yeah, it's just like I don't know the value of my house. I have an idea, and I'm curious when there's neighbors sell their houses. What's that going for? Maybe it have an impact on what mine is worth. I don't really know.
And if you want to get out of it, there's a lot of friction. So the other thing is some of these firms right now are actually still doing 5% distributions of the principal amount that you deposited. But they're not earning 5%.
They were sold to investors, hey,
steady yield.
We're going to get steady yield, and you're going to own these assets. It's going to increase in price over time, and you're also getting this nice fat check every month.
Yes. So they were particularly appealing when interest rates were at zero, and these paid dividends of roughly 4%. And they had the allure of, hey, look, it's real estate. There's no risk in it. So again, if you were approached by an advisor that wants you to buy a non-traded REIT, just look at it and say, what other alternatives do I have? And it doesn't matter what asset class you're in. It makes no difference. The hottest thing a couple of years ago were apartments. Apartments, you can't go wrong on apartments. You can raise rates. That isn't the case. Well, the challenge
it's the challenge with these commercial real estate properties right now and apartments. It's what happened to interest rates. And it's not like these properties have 30-year fixed mortgages.
Yes, they mature 3, 5, 7 years.
Interest rates are fixed for a short period of time.
That's right. And not only that, Scott, is that when the yields were so high, it's a supply and demand. So it actually draws more capital into that side of the market. More buildings are built. I saw it, before we go back to the call, I saw a fascinating article last week. I didn't print it out, but it had to do with mortgages on lodging properties, hotels in the city of San Francisco. Last year, 4%.
Oh, I saw that.
Did you see that? Was
Yeah.
it 4%?
How much? What percentage?
Were in default.
Oh my God! Like 40.
Well, they weren't in. They were late payments. 41%.
Was it 41%? That's I remembered 40 something.
41%. 41%. So things change. Things change. But look, when you buy something, worry about liquidity. Worry about liquidity.
Yeah, and the challenge with these non-traded REITs, if people, well, a lot of times brokers sell them because they get paid big commissions. Yeah. Anyway, I think we're wrapping up our time. By the way, if you value this podcast, you think it's helpful, a couple things. One, forward it on to someone you think could benefit, particularly if there's an episode you hear like, I think Johnny could enjoy that. Forward it on to, please, Johnny or Jill or whatever.
Okay.
But also give us a review. You can just pretty simple. I gave someone a review just the other day on my Spotify account and click and gave 5 stars. And I thought it was a good podcast. That's why I did it. So anyway, appreciate you doing that. And we'll see you again next week. This has been Scott Hansen, Pat McLean of Allworth Money Matters.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.